This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I wanted to talk about Kogan's full year results, share my thoughts on why the stock dipped 15% today, and hopefully explain why the stock has dropped so much. And it's also been a pretty busy day for me. A lot of the companies that I cover on this channel have reported their earnings today. So for example, Somerset, Heartland Group Holdings, Center Group, as well as Kogan. So all reporting on the same day. So I've been really busy, and I will be making more content on those full year results or half year results, whatever it is, later on this week. So if you enjoy these type of videos, be sure to hit like, hit subscribe. But with no time wasted, let's get right into today's video. So Kogan's full year results caused the share price to dip 15.77% today, down $2.07. The shares are currently trading at $11.06. And this is in stark contrast with a shopping mall company called Center Group, which I've covered before on this channel, up 6.67% today. So this is up during a pandemic when no one is going out shopping or staying at home in lockdown in Australia and in New Zealand. Both these companies have exposure to Australia and New Zealand, and we are in lockdown at the moment. So this does show that the market doesn't necessarily follow logic. Sometimes it operates in weird ways. All right, but a lot of these issues are not industry specific. It is more company specific. So let's talk about why Kogan actually did dip so much. So there's two things that you need to know when you see a huge share price drop when a company reports its results. So the first thing that drives the movement of the share price during an earnings report is the guidance and consensus and whether that level has been met. So if you have earnings guidance of 100 million but you only delivered 50 million, so you missed by 50 million, that would cause the share price to drop a lot. And on the other hand, if you exceed it, then the share price usually would go up. And the second thing that determines share price is also on future guidance. So if the management team decides to guide, say, we're going to do more profit next year, 10% higher, then usually the share price might follow unless it's already been priced in. And the way things are priced in is usually reflected in the PE ratios. So the first thing that I want to touch on is, of course, guidance and consensus by the analyst community as well as the management team. So in July, management did give us an update that adjusted EBITDA was going to be 61.1 million, up 23%, revenue 780 million, up 56.8%. The analyst consensus for net sales was 781, bang on with guidance, EBITDA of 60.2 million, which is slightly less than management's guidance, and net income of 22.6 million. So this 22.6 million obviously was not in management's guidance. So this was actually a real estimate by the analyst community. So when you look at the front page today on the AFR and you see the headline, Kogan shares dive as dividend suspended and profits plunge, you'd be really worried, and you look at the share price down 15%. So it's no surprise that you might be wondering why the share price is down so much. And then you read this: the online retailer withheld its final dividend after net profit plunged 87% to just 3.5 million. So that 3.5 million compared to the net income is a huge difference, right? The consensus was 22.6 million of net income, but they only delivered 3.5 million. So now let's take a look at a deeper dive on their earnings report to see what actually caused the difference between the two. All right, so the first part of the FY21 highlights was relatively good. We saw gross sales up 52.7%, revenue up 56.8%, gross profit up 61%. We also saw active customers up 46.9% to 3.2 million. We also saw exclusive brand sales up 62.5%, and exclusive brands make up the majority of Kogan's revenue, 55.9% of revenue. So that's an increase of 145 million. So that's a huge increase in exclusive brand sales. The second largest contributor to revenue is third-party brands, and that is up $43.1 million as well. So that's quite a significant year-on-year growth. We saw the marketplace gross sales up 91%, and Kogan First members is at 120,000 members. But then we go on to the highlights and we see this over here, and that starts to trigger some warnings or red flags. Adjusted net profit after tax up 43.2% to 42.9 million, but net profit after tax down 86.8% to 3.5 million, reflecting one-off inventory, logistics, and Mighty Ape acquisition costs. So that's a huge difference between net profit after tax of 3.5 million and adjusted net profit after tax of 42.9 million. So the difference between net profit after tax and adjusted net profit after tax is that net profit after tax is the accounting standard. In the US, they call this GAAP, or Generally Accepted Accounting Principles. This is a unified standard across all companies, and on that net profit after tax figures, you include all your expenses, including any one-off expenses. Adjusted net profit after tax, or underlying net profit after tax, or normalized net profit after tax are management profit numbers. They can decide what to add in or take out. Management teams like to exclude any one-off expenses because these don't necessarily reflect the day-to-day operations of the business. It's not a recurring thing, so it doesn't actually reflect the operations of the business. However, in certain industries like retail, there's not necessarily a huge need to use an adjusted profit figure. And you would also be very concerned when you see such a huge difference between the adjusted and the non-adjusted profit. So that is definitely something that I'll look into if I'm seeing something like this. So over here in the slide provided by management in the earnings report, it shows us the differences between the adjusted number and the net profit number. So we see 3.5 million net profit after tax, and all these adjustments basically contributed to the net profit after tax of 42.9 million adjusted. All right, so let's go through all of these items. So the first one is unrealized FX gains and losses. Now, this is usually an expense that the company incurs when they have some kind of foreign currency risk. So they might have hedges in place to hedge against movements in the foreign currency. So in my opinion, this is a fairly normal expense. Most businesses have this, and over time you'd expect these fluctuations in the FX to balance out over time. So I think that's correct. That's fair to have 1.4 million as an adjusting item. Equity-based compensation, this is the expense related to issuing stock options to the management team. So Kogan did issue a lot of options to Mr. Kogan and the CFO, which I'll touch on a little bit later on in the next slide. But basically, this is a real cost to the business. This is an actual expense, but a lot of management teams like to exclude it out of the real profit figure because it's not really a cash item, and you can argue it's not really recurring. But I would say that this is a real expense. So I feel like, in my opinion, personally, I would include this in my consideration when assessing real profit over time. Now, moving on, we have donations of 2.5 million. So this 2.5 million was actually PP&E that Kogan donated away. The PP&E related to equipment that they needed for the Rona, like sanitizer and stuff like that. They ordered too much and they realized they didn't need that much, so they donated it away. So this definitely makes sense as a one-off expense because they're not going to recur the same expenses next year. They're not going to order huge amounts of PP&E because they've learned from their mistake. Similarly, with the Rona related stock provision, this is basically expenses that they incur when writing off old inventory, and they arguably mention it's because of Rona. Maybe, maybe not, but it's 2.2 million, so not significant in the grand scheme of things. Rona-related logistics costs, so that is the demurrage fee that they had to incur because they couldn't take out stock off the ships, and the ships charged them a penalty. So management had already said that this was fully incurred in this financial year, and they won't incur that in future years. So I agree with them that that is definitely a one-off cost. And lastly, the Mighty Ape purchase tranches of 12.8 million in total. That relates to the acquisition. That's a very normal sort of agreement in the market where you have an acquisition, you have an earnout provision. And if they meet certain EBITDA targets or other financial metrics, then you pay that earnout. That is a very normal structure, so that is definitely a one-off expense in my opinion. So out of all of these expenses, I think the equity-based compensation is definitely not a one-off expense, because that is a real cost to shareholders, and you will incur that until the share options that you issue to management expires. So now let's talk about the options that Kogan issued to the management team. So Kogan.com proposed to grant 3.6 million options to Mr. Kogan and 2.4 million options to Mr. CFO, and this was already passed. And basically it was a really tight vote. A lot of people were against it. 56% voted for it, the rest against. So it was a very polarizing vote. There's a good reason why, all right? So the options have an exercise price of $5.29, and this price was agreed between February 1st and April 30th. And that was when the negotiations for these options were starting. And during that time, the pandemic spread, the share markets tanked, but Kogan's share price went up to as high as $25.57. So at the time when they actually approved this resolution at the AGM, the stock price was already well above the strike price. So how an option works is that you have a strike price, which basically lets you buy Kogan stock at that specific price. And generally speaking, you would only exercise those options if the share price is above that strike price. So if you have such a huge margin where the current share price is $10 and the strike price is $5, then management doesn't really have a lot of incentive to continue to perform well, because if the business suffers, say if it drops 40% to $6, you can still make some kind of money. So those are not good options because it's way too deep in the money. On the other hand, if you have a share price at $1 and strike price at $5.29, that is very hard for management to achieve that, and they won't be incentivized to perform well as well. So you don't want options that are too out of the money or too deep in the money. You want options close to where the share price is currently trading. So the reason why this was polarizing was because the shares have already soared, and that meant that exercising these options were basically guaranteed. This was why it was quite polarizing, and that also is why Charlie Munger likes to talk about incentives. Show me the incentive and I will show you the outcome. So personally, what I think about the structure is that it was probably not the best structure. However, it does still give Kogan and the CFO an incentive to stay, because as mentioned over here, they can't resign before the 2030 results. Otherwise, they won't get to exercise those options. So that is frankly the cost of doing business. You have to incentivize your management teams, and this is a lot of options. This is a lot of money, 3.6 million options and 2.4 million options. That is a lot of cost to shareholders, but at the same time, you have these operators which have been involved in the business since it was founded in 2010. So this is a great way to keep managerial talent. And if it is reflected in the net profit figure, then the real net profit figure should be closer to 31 million rather than $42.9 million. Right, so on today's share price of $11 roughly, that represents a PE ratio of roughly 37 times. That is a fairly high PE ratio, but remember, this is a business that's still growing tremendously well, and going forward, there's a lot of tailwinds for this business. Now, if we look at forward guidance, there's a lot to like about this company. Now, management has mentioned that gross sales have grown by 5.1% over July 2020 numbers. Gross margin improved on June 2021, well below July 2020. High operating costs, which are gradually reducing. Inventory of 215.4 million. Now remember, inventory as at balance date was 227.9 million, so we've seen inventory gradually reducing. Now there's also a strong balance sheet that supports the planned growth initiatives of the business, and Kogan First members were 147,000, which was an increase of 27,000 since balance date at 120,000. So Kogan First growing quite well. And they also said that in the first 18 days of August 2021, Kogan has shown strong acceleration above July 2021 performance, with gross sales 24.5% above July and gross profit 25% above July for the equivalent number of days in unaudited management accounts. So this statement over here does give us a good indicator on how the lockdowns are impacting the performance of Kogan in Australia as well as in New Zealand. There's a lot of ramping up happening, and this is what we expected. With the lockdowns, Kogan should do well. All right, now I've also jotted down some notes on the conference call which you might find interesting. The company anticipates potentially implementing logistics projects potentially operating their own distribution centers in addition to third-party centers. This is a low capex project while delivering a purpose-built solution, meaning that there's more control and hopefully as well lower costs over time. Online retail is growing significantly. Kogan.com is taking market share and inventory is correcting over time. They could potentially be on a shortage later on in the year as the Christmas period approaches Kogan. So this is definitely a lot of good things for the business heading into the end of the year. And with lockdowns happening in Australia, New Zealand, I think this will help Kogan clear out a lot of their excess inventory, basically giving them a get out of jail free card with their inventory solutions. And just today I was looking at Mighty Ape's website for chocolate, and I noted that Kit Kat was trading at $65 for a 12-pack. So that is a huge premium on Kit Kat, and I was thinking what the reason for that could be. The only thing that I can think of is that they don't actually have much stock left, and a lot of people are ordering snacks from their website because they are actually delivering. So it's quite hard to get online stuff from supermarkets, Countdown, and Pack and Save. So a lot of people are now looking to Mighty Ape to buy their snacks. So this does look good for Mighty Ape. There's not a lot of inventory actually on their website for snacks because I was trying to look for some. So it's definitely an interesting position where the company is at the moment. The share price drop, I think, was due to the poor headline. $3.5 million shocked a lot of investors. But if you look deeper into the performance, it's actually not that bad. As well as that, another contributor to the dropping share price could also be due to shorters shorting the stock. Kogan is one of the top 10 shorted stocks on the ASX, so I'm not surprised if we later see a reversal in the share price as we have seen in the past. So Kogan is definitely a stock that I continue to hold, and I actually did buy a very small number of shares on the public Sharesies portfolio. So that is all for today's video. Let me know what you think about Kogan in the comment section down below. Thank you guys for watching. Until next time guys, take care.